Hello, everyone, and welcome to another Coffee with Carl. I'm your host, Carl Zoellner, one of the attorneys here with Anderson Business Advisors. And today I wanted to talk about a subject that's near and dear to most of our hearts, and that's retirement. Some of you may have plans to have your toes in the sand, and today I wanted to talk about some of the interesting things that don't get really talked about when it comes with retirement plans. Now, in a previous video, I talked about some of the differences between IRAs and 401ks or qualified retirement plans. Today is more about a little bit more focused on the tax side and what we should look at when we're looking at using plans that can defer taxable gain, meaning our traditional 401ks or traditional IRAs, and also we can take a look at Roths. So if there's one big rule that most people know in real estate, if we're looking at real estate, it's location, location, location. I would say if there's a universal rule in tax, it still has the same three words again, but we're looking at calculate, calculate, calculate. Now, if I'm contributing to a tax deferred plan, this is an example of what I'm speaking about. If I'm contributing to a tax deferred plan and I'm in a tax bracket where I may be, in a lower tax bracket as I sit today, but I'm going to be in a higher tax bracket when I retire, may not be the best solution for me to put it into a traditional IRA or traditional 401k unless there's a conversion process I can do that'll help me out at the end where I don't actually pay taxes at my higher tax bracket. Same thing with a Roth, right? If I'm contributing to a Roth and I'm in the, 37% tax bracket right now. Well, I guess I technically would have timed out the 37% tax bracket, but if I'm in a higher tax bracket when I'm contributing to my Roth than when I'm planning to take it out, that doesn't really make sense from a mathematical standpoint either. So the idea is that while retirement plans are a great idea, and I suggest everybody have one, I have a Roth IRA I trade out of. Also have a 401k through Anderson here. There's lots of different ways to contribute, but we need to look at the math when we start with these things so we understand. Now, our position here at Anderson is that 401ks generally are a far superior contribution vehicle than an IRA, simply because I can contribute in 2020 now up to $57,000 a year into my retirement plan, which provides some great planning opportunities, as well as if I may be a little bit behind in my retirement planning, I can contribute more than the standardized, $6,000 for the IRA. So we like them in that regard. Also, I like the solo 401k plans because it has those three different buckets. It's actually almost four when we start talking about 401ks. We have the profit sharing, we have the traditional contribution for the 401k, as well as a 401k Roth bucket. And I say there's almost four because if you have an employee account, you have the ability to roll money out into a Roth and able to take that money tax free at the end. So it's important to know and understand the different tools at your disposal, whether you're a real estate investor, whether you're a small business owner, or almost any path you go down. It makes sense to look at these options. However, you want to work with an advisor who knows what they're looking at to make sure you're not shooting yourself in the foot without even knowing it. So just remember, when it comes to the tax portion, especially when it comes to tax deferred accounts or Roth accounts, we want to make sure we're doing the calculation to make sure you're using the account that's right for you at this stage in your life. Also, we also want to take a bit of a look and sort of look into the future a bit and see where you may be to make sure that it's the right solution for you. There's tons of options out there to fund retirement, everything from even defined benefit plans to non-qualified plans, and I've even got a video coming up on indexed universal life plans, which is a type of insurance policy you can use for basically using as your own private vault. So really like to talk about this sort of thing because when we start to look at business, we tend to focus on a lot of times getting sued. And I think that the tax portion is actually something we're guaranteed to have to deal with every year. And it's nice to be able to plan for it since we know we're going to have to deal with it. Lawsuits we still need to prepare for, though, because we don't know when they're going to pop up. So That's it for this episode of Coffee with Carl. I encourage you to keep taking advantage of all of our free content. If you haven't been to one of our live in-person classes yet, our tax and AP events, I'd encourage you to visit andersonadvisors.com, find the one that's next on the schedule, and hop in there. I'm looking forward to doing more of these videos. It's been fun. If you have any subjects you'd like me to cover, just leave them in the comments, and we are working through the comments. So until next time, it's been a pleasure. Thanks for joining me with Coffee with Carl.